Hi, I'm Brett Cenkus, the right brain business lawyer and a business consultant. Today we are talking about something that a lot of startup founders, business owners struggle to understand. They're 83B elections. So 83 and then B in parentheses, which is a reference to the IRS code 83B. Let's talk generally about where 83B elections come into play. They come into play when someone is given stock or LLC interests, a type of equity that is vested over time. So vesting means you're getting something today, but it's really not yours. You can't walk away with it. So in the case of stock or LLC interests or some other type of equity, usually, not always, but usually you can vote those shares and you get dividends from them. But if you were to leave before the vesting kicks in, then you don't get to walk away with the shares. So typical Silicon Valley style vesting for founders in a venture capital backed company is going to be 4 years with a 1 year cliff. What that means is if our founder is given a million shares, the 1 year cliff means he will not get anything for a year. And on the 365th day, they receive or finally get to keep 250,000 shares. And then over the course of the next 3 years, the remainder of the 4 year period, they'll vest equal tranches or slugs of stock. So the other 750,000 shares will vest over the course of 36 months, something like 20,000 shares a month. So again, up front, our founder would have a million shares, be able to vote them, be able to cash the dividend checks. But if she were to walk away before the end of the first year, she walks with no shares. And after that, pro rata. So the reason vesting is used, venture capitalists almost universally require it. You really need to earn your equity. You're not given a whole bunch of equity usually just because you had a good idea or you showed up on the first day. You got to be there for a while. And if you leave early, if someone doesn't work out on the team, it's important that they leave most of that equity behind, depending on when they leave, because you've got other people who have to come in and be in that role, take over for them. So again, you kind of earn your equity over time. Very common. There's two concepts you need to understand to really understand the 83B election. Just two. Now the first is that when you receive something as compensation and it's worth more than what you pay for it, the IRS taxes you on the difference, right? So if I come and I give you a bunch of shares of stock in my company and you don't pay anything for it, you have a taxable event. I need to send you a 1099. You need to pay for that. That's concept number one. The difference between what you pay and what you get in the compensation realm, you pay tax on that. The second thing you need to understand is when you have vesting on that stock or equity, the IRS doesn't treat you as truly receiving it until the vesting falls off, until it's no longer subject to what they call substantial risk of forfeiture. So in the example earlier of the 4 year, 1 year cliff, on day one, our founder hasn't, for tax purposes, received anything. Remember again, she would have shares, she could vote them, she could cash dividend checks, can't walk away with them. The IRS would not treat her as owning those. On day 365, when 250,000 of them vest, the IRS would say, taxable event, you receive shares on this day. So the reason this can become a problem is in the typical venture-backed company, the idea is you're going to do multiple rounds, and every round, hopefully, the company's increasing in value. So on day one, when our founders get together and issue themselves founder shares, the shares aren't worth anything. They're worth hardly anything, maybe a couple $1,000 that the founders put in. So they're really worth hardly anything. So the million shares our founder would have received on day one, arguably, defensively, aren't really worth anything. There's no taxable event. But if they don't vest, remember, the IRS doesn't treat the founders receiving those. But on day 365, maybe they're worth something. Maybe the company has done had a valuation event, done a round, grown. In the second year, the third year, the fourth year, hopefully the value of the company is going up and up and up. So what that means is the shares the founder's receiving, right, when the vesting falls off, are worth more and more and more. But the founder's not paying anything. Not usually. Founders paying something negligible, something called par value. So that means they're constantly getting these valuation events. They're getting tax bills. And they have a liquid stock they can't sell. So the 83B election takes care of that problem. never say there's no free lunch. I mean, this is as close as it comes to it, because if our founder files an 83B election upon receiving that million shares on day one, even though they're subject to vesting, okay, the IRS says, okay, we'll accelerate the taxable event and we'll tax you entirely on day one. And remember, the shares are arguably worth nothing. When I say arguably, what I mean is that would be what you would say to the IRS, and they, in every instance, would agree with you. And our founder paid almost nothing, so there's no taxable event. And then as the vesting falls off, hopefully the stock's growing in value, but our founder's not having to pay tax on it. Ultimately, when the founder sells those shares, they would pay tax on the difference between, zero or whatever they paid at the beginning and the sale price. So the IRS, no surprise, will ultimately get their money. But it avoids a couple issues. Number one, it defers the tax. Plus, you overcome the issue of having to pay tax on illiquid shares. Because if you pay tax on a private stock and never sell the stock, then all you had is a tax bill and you never get liquid. So that's the one thing to watch out for, by the way. Sometimes later on, as companies grow, you get restricted stock and things like that. And I saw back in the .com days, a lot of people paying accelerating the vesting, filing an 83B election, paying tax today because they assumed during 1998, 99, and 2000 the stock's going to go up forever. Well, then when it dropped precipitously and couldn't be sold, it wasn't worth anything, the employees were still stuck with these tax bills. So again, that's 83B elections. It's as close to a free lunch as it comes. Decisions, if the company's, if those shares are worth something, it becomes harder. But at the time when you're founding a company, if you're going to vest the shares, you almost always want to file an 83B election. You have 30 days to do it from the date you are granted the shares. So you send in your 83B election to the IRS, you send it with a self-addressed stamped envelope, you send it certified return receipt requested, and you've got 30 days, and that's it. Do it or lose it. So I'm Brett Cenkus. If there's still something confusing, or you have a question, or I didn't cover something, leave me a comment. If you want to hear something in particular, shoot me an email, brett@cenkuslaw.com. Appreciate you stopping by. I will see you in the next video.